Right, lads and ladies, let's get into it. Excuse me, 2 seconds. Right, lads and ladies, let's get into it. What have we got today? Today is a very important, no chart work today, but it's a very important video. It is about your trading plan and why you need one and how to create one and what should be in your trading plan. So your trading plan essentially, before we dive into it, is just a list of rules, if you will, to stick by, kind of like a checklist before you get into your trade. So once everything's ticked off, handy, beautiful, then you'll enter the trade, and only then will you enter the trade. It's important that you have a trading plan because helps take the emotion out of the trades. You're not just buying in at this level or selling in at this level because it looks good or it's either taking this high and that high or whatever it may be. You have a clear and concise plan, and if you back test your strategy, well, then you know that you have a percentage rate for your strategy. So then it gives you that bit more confidence when you're going into your trade. So if you can confidently say that 60% of the time you take 100 trades and 60% of the trades that you win, handy. Well, then you can say that 60% of the trades that you're going to take, you can win. So if you take 4 trades in a row, it's not going to be the worst thing ever because you know that 60% of the time you're winning. So now, how do we create our trading plan, and what is a trading plan? The importance of a trading plan: trading is a game with no rules, so we have to make rules for ourselves. A trading plan is essential for any successful trader. It acts as a roadmap, guiding you through the complexities of the market. Without a clear plan, you are more likely to make impulsive, emotional decisions that lead to poor outcomes. With a trading plan, we know what we are looking for, and if a trade doesn't present itself as per our trading plan, we don't take it. Rule number 1: let the trades come to you and don't go and chase the trades. It's important that we know and understand that there's always going to be a trade in the market. The markets are going nowhere. They've been around for centuries. They're going to be around for centuries after we're gone. There's always going to be a market. There's always going to be a trade. If you miss a trade, it's fine. You can get another trade. If you don't try chase your trade, if you're already in 20, 30, 50 pips in profit, don't try just get in because the analysis was correct, so I'm going to get in, because I can guarantee you when you get in, that's when the trade will go bust. It always happens to everybody all the time. So it's important to stick with your trading plan once you make them. So what is a trading plan? A trading plan outlines your risk, your strategy, including your entry and exit points, your risk management rules, and specific goals. It provides structure and discipline, helping you to approach the markets with consistency and control. Why do we need them? For consistency, our risk management, our emotional control, and our measure. Excuse me, to measure our progress. So we have a trading plan. It allows us to stick to our strategy and avoid erratic emotional decisions. Our risk management plan should be written down into our trading plan. Whatever it may be, make sure that you stick to your risk management that's in your trading plan, that's outlined in your trading plan. Because if you watch the risk management video, if your trading plan means that you have to take a 1 to 2 or 1 to 3 risk to reward and you have to hold it, that's fine, do that. But if you start taking out at a 1 to 0.5 and you're up at 1 to 1 and you take out a 1 to 1 instead of holding it to a 1 to 3, that skews then your percentage win rate because you're not holding it to a 1.1 to 3 anymore. But if you look at the risk management video, it goes a lot more in depth about that. So now we're just going to jump to how can you create your own trading plan and some questions that you need to ask yourself. Let's start the risk. When you're creating your trading plan, we want to say, right, well, according to our account size, what is our designated risk per trade? Are you risking 1%? Are you risking 2%? Are you risking 5%? Are you risking 3%? Don't risk 5%, risk 3% max. And understand that if you're risking 3% in a 100 quid account, man, you're only risking 3 quid, so you really stand to make fuck all. But it's all about seeing in the future. So you need to be able to say, right, well, I only have 100 quid or 1,000 quid in my account now, and I might only making a 10 or a 30 or 50 or 100 quid now. But you have to be able to see into the future when you have a 10 grand account, when you have a 100 grand account, a million quid in your account. You need to be able to see what your profit is going to be in the future. So don't just get, oh, well, I'm only making 3 quid. If you can consistently make 3 quid on your 100 quid account without taking losses or taking a minor loss and your risk management is on point, that is much better than going in and risking 25% of your account per trade and doubling your account. Happy days, because that only lasts so long. Look, every trader develops it. Every trader has it at the start. You get into a phase and you start trading, happy days, and you make a few quid and then you lose it all. because you don't know how to keep it. You don't know how to hold on to the money that you make. Capital preservation is just as important as making the capital itself. Because how are you going to trade if you blow your account? How are you going to trade? You have no money to trade. You can't trade what's not there. So your risk per trade is important, and just a note: make sure that you don't lose sight of the end goal. Always be adding the zeros on. Although you might only be making 30 quid on a trade, and you might not think that's a lot, or a tenner on a trade, and you might not think that's a lot. Add a zero, add 2 zeros if that's what makes you feel better. Do you know what I mean? And look, really understand and look into the future and see what that is, what trading for you is going to be like in the future, if this is the endeavor that you want to embark. Now, what is your designated risk per day? So you might have a tenner risk per trade, and you might only want to risk €50 a day. Perfect, fine, no problem at all. You can afford to lose 5 trades and you're out. Or you might want to risk €20 trade, and you might want to only risk €40 in a day. So if you lose 2 trades in a row, you're out. And now that goes on to question number 3. How many trades are you going to take in a day? And another question: how many trades are you going to lose in a day before you stop trading? See, a lot of people get into a habit of, oh, well, it's gambler's fallacy, it's called. It's when you go in and you say, right, say you're spinning the roulette wheel. Oh, but it's after hitting black 5 times in a row, so it has to hit red. I'm bound to hit red. It never hits red. It's always going to hit black, because you're going to keep thinking it's going to hit red, it's going to hit red, it's going to hit red, and it keeps hitting black and it keeps hitting black, and you keep putting money on red and you keep losing your money. So if you go into the market, it's the same way with the markets. If you go in and you lose a trade, that's fine, no problem. Everybody loses trades. Losing is a part of trading. But if you go in and you lose 2 trades, okay, that's no problem. If you go in and you lose 3 trades, okay, close your laptop, turn off your phone, and leave it at that for the day. And allow that to be it. Make that a rule. How many times you're going to lose in a day before you close your laptop? Because if you don't and you keep going, you're just gambling. That's what you're doing. You're just gambling, and you're just revenge trading, which is the worst thing you can do. You're getting greedy and you're getting angry, and you're getting pissed off with the market, and you're going to think you're going to one up the market. I'm going to get this right, and I'm going to make this money back. And you never do. You're always going to blow your account. So it's always good to take a loss in the chin, because losing is a part of trading, and that's just that. And what's your designated risk to reward ratio? Another thing that you might have in your trading plan, which I forgot to mention in the risk to reward or in the risk management video, is taking partials. When are you moving that stop loss into break even? When are you securing partials off the table? Okay, well, if TP1 is hit and you have TP2, let's say, are you going to take 50% of your trade out at TP1 and move your stop loss to break even? That's the best thing you can do, because you're taking money off the table, which means you're already up on this trade and you're protected if the trade goes tits up. It's no problem at all. But is that what you're going to do? What are your risk parameters that you're going to take for the trades and for the day? And then how are you going to manage your risk throughout that single trade and each and every single trade throughout that day? Yeah, if your risk gets reached for the day, stop trading, go on a walk or something. What's your risk to reward? In other words, how much do you stand to lose? Yeah. And now, lot size. So your lot size and your risk directly linked. What lot size should I be using? In accordance to your account size, what lot size should you be using? There's good calculators you can use. You can use, I think it's for every £100 that you have in your account, €100 that you have in your account. Excuse me, it's a 0.01. So if you have if you have 200 quid, go 0.02. Rule of thumb, I'd go 0.01 until you have 300 or 400 quid in your account, and then slowly start working up to your 2s and your 3s. If you have 1,000 quid in your account, happy days. You can probably get away using a 0.1, depending on your risk parameters and what you can afford to lose. I might be more comfortable losing more money than you're willing to lose, and you might be more comfortable losing more money than I'm willing to lose, and that's fine. Yeah, so what lot size should I be using? I'm calculating my lot size on a percentage of my capital in my account. So are you going off, right, well, I'm going to risk €50 per trade, every trade? Or am I going to say, right, well, I'm going to risk 2% of my account every trade? And as you compound your account up, that 2% is going to gradually be risking more and more and more. Very small amount more, but more nonetheless. So that's another question now. Are you calculating your risk in dollar terms, or are you calculating your risk in percentage terms? Some people find it easier to calculate their risk in percentage terms because they have that emotional connection to the money. They say, right, well, if I lose 1,000 quid or if I lose 100 quid, well, then that's a day's wage that I'm down. So I'm down 8 hours of work or 12, whatever way you work. That's how much I'm down. So if you look at it as a percentage point of view, it kind of takes that emotional attachment to the money out of it completely. I'm calculating my lot size and how much I can afford to lose instead. Yeah. So are you calculating on your dollar amount or on your percentage of your capital that's in your account? Are you calculating your risk every time? It's easy to do with MT5 now because you just have the bar that you can just scroll up and down. So if you have a dollar amount, you can just say happy days, and then if you're risking 50 euro per trade, it's easy to do. You don't really need to put it into a calculator the way I used to do it in MT4. Steno, I think, was the name of the app. Good app, brilliant app if you want to use it, but you don't really need to use it now because MT5 have the upgraded thing. You can just slide it up and down and see how much you stand to gain and how much you stand to lose. But yeah, if you're calculating your risk every time, no hassle. And I'm nearly sure with MT5 you can change it in your settings. So instead of it coming up a dollar amount, it will come up a percentage amount that you're risking, which is brilliant as well. Yeah, or are you using a set lot size for every trade? So it's important because your lot size and your risk is directly tied together. So if some trades you're risking, if some trades you have a 0.05 lot, and sometimes you have a 0.1, and sometimes you have a 0.01, that significantly skews the risk to reward ratio that you have, because you can no longer lose 100 quid in order to make 100 quid or make 300 quid because you're using different lot size. So you're losing 50 quid to make 100 quid or 150 quid. So it skews your risk to reward. So ask yourself these questions, sit and think about it, write it down, think about it, even play around with it on a demo account or your live account or whatever it may be. There you go. There's a calculator that you can use. And for your sessions, it's important that we know what sessions we're trading on, because certain sessions have certain volatility or volume in them. If you trade Asian session just naturally has less volume than London and New York. London has less volume than the New York and London overlap. So what way are you trading? But what time of the day can you trade? If you're working a 9 to 5, it's probably not best for you to be trading in work, because, well, for me personally, anytime I traded in work, I've always lost all the time. The analysis may have been correct, but I've always lost little stupid things as well that you would have caught if you were sitting behind the laptop looking at it. It's fair enough, but set the plan so it works for you. If you're taking trade ideas, happy days. But if you're taking your own trades, or even when you are taking the trade ideas as well, what sessions do you want to be trading in? And if you look at the time zones video, you'll understand the difference between the sessions and the volume and volatility that each session has. What time best suits me to trade? Like, do you finish work at 4 o'clock and you jump in the charts for a few hours after that? Or are you working a 9 to 5 and you can only kind of trade Asia session, which is no problem. There is still money to be made in Asia session, just less volume. So markets move slightly slower than they would on the London and New York overlap. Those overlaps are what we call kill zones. That's when you have people from the US and Europe all trading at the same time. So there's just more volume, more volatility in the market, better chances to make a profit. Also riskier time to trade though as well. Can you trade this time of every day? Just ask yourself these questions, write them down and answer them in your own time. What session is it that I'm trading? Who could be on the markets at that time? Bear with me. Who can be on the sessions at that time? We want to trade the same time and earn up the same time every day, so we can start to notice a pattern at a certain time, such as how price reacts in New York market opens or London, etc. Me personally, I like trading 2:30 Irish time, so that's 9:30 a.m. New York time. That is London Stock Exchange open. That's when a lot of the volume comes in. And if you back test and look at your charts, you'll see it clear as day. And there's actually, I haven't even got tried to open. It's going to take ages to open as well. This thing's taking ages to load everything. But what was I going to say? Yeah, that's personally the session that I trade is pre-market New York. So about 1 o'clock, 12 o'clock Irish time. That'll be about 7, 8 o'clock in the morning for New York. And then once the New York traders jump in at New York Stock Exchange open around 2:30 our time, 9:30 their time, then the volume starts to come in. And it's important to note as well, I'm in Ireland now, so although I might finish work at 5 o'clock, close the laptop, happy days, it's only 1 o'clock over there. 12 o'clock over there, it's they're 5 hours behind. So if it's 10 p.m. over here, it's 5 p.m. there. So they're still in the heart of their trading day. So if you don't finish work till 5 o'clock Irish time, that's no problem at all, because 5 o'clock Irish time is only 1 o'clock their time. So technically you could be on the chart at 7 o'clock and still catch a lot of volume and volatility. because there is people trading those markets. Now, for news trading as well, we have different ways that we can trade news. We have: are you going to trade around news? Are you going to hold off and not trade news at all? Are you going to trade after news? Are you going to wait for the release? Are you going to hold through the release? There's a million different ways to trade it. We'll do a news trading video on how to trade news on its own, in its own video. But these are just some questions to ask yourself. Are you trading before, after, or holding your trades through news? What sort of news will you not trade? NFP, federal funds rate, tend to be two of the most volatile. So are you trading those? Are you not trading those? Excuse me. And then there's no harm if you don't want to trade those days at all. There's a lot of manipulation in the markets with news days, so you don't have to trade those days at all if you don't want to. And then we have: what sort of pairs are you going to trade? Where's it gone? What sort of pairs are you going to trade? Do you trade currency pairs? If so, are you trading major? Are you trading minor? Are you trading exotic? Which ones are you trading? What's the difference? Know the difference between them. What I will say is, don't try trade everything. Don't try trade all the currency pairs, all the commodities, all the indices, all the cryptos. Don't try trade everything. Have a select block. Maybe trade. I trade EU and GU because they're correlated pairs. They kind of move in tandem with each other. If one's looking a bit dirty, well, then one might have healthier price action. Same with the ES and NQ. That's just your S&P and your NASDAQ. Same thing. They move in tandem with each other, so it's easy to kind of look at one to see what the other is going to do. Gold and silver, handy. You can trade those as well. I personally have had zero luck trading cryptos. Zero luck trading cryptos. People have. I just have not. Price action still moves the same. I just haven't. Every time I trade, I lose money, so I don't trade. I stay away from it. But yeah. So what pairs are you going to trade? How many pairs are you going to trade? I would recommend, man, don't have 10. Like, have 5, maybe 4, maybe. I trade GJ as well when the US pairs are doing all sorts. Like, but diversify. Look, I have GJ for when Euro and GU are acting the bollocks, and then you have gold and silver. Everybody trades gold and silver. Silver more so just to look at it. Gold to trade. Everybody trades it. But there's a lot of traders that would just trade gold. So if you just want to trade gold, there's no hassle in that at all. If you just want to trade gold, well, then just trade gold. It's no problem at all. You don't have to have multiple things. It's just good to be able to diversify. Yeah, well, if gold has choppy price action, well, maybe I might look at GJ. GJ has probably my choppy price action. Let's look at UJ and see what's going on. Choose what fits you, but don't choose too many. Choose a handful, man. Don't choose more than 5 is a lot. I think it's a lot, because how are you gonna put your attention? How are you gonna know what 5 different currency pairs are going to do unless they're linked? Like, you might know what EU and GU are going to do because you know the dollar is going to do. But if you have some mad like the rand and the ruble and the rupee, then you need to know what's going on with the rand and the ruble and the rupee, and the dollar and the pound and the yen, and everything, and the euro. It's easier to just focus on one thing and give it your full attention. I think there was a saying. It was like, I read in the book somewhere. It's people who say they can multitask, they can't, because your brain can actually physically only focus on one task at a time, fully focus on one task at a time. So if you say you're multitasking, that's fine. You might think you can multitask, but realistically, 60% of your focus is going here and 40% of your focus is going here. So you're not multitasking. You're just taking 40% of the focus off of this side and you're putting it onto this side. So you're not giving anything 100% focus. So just don't take on too many will be my recommendation. Stop losses, yeah, this ties in with your risk management. When do you move your stop loss to break even? Am I using dynamic stops where you just have a fixed stop and you don't move it? Are you using your trailing stops? The thing with using dynamic stops is you can always risk price coming up just about scraping your TP, not hitting it, and then reversing back out and you're bust just because you didn't want to move your stop. But if you move your stop too early or you trade your stop, you often risk being, especially with gold, tapped out, and then price will go in your intended direction anyway. So it's kind of, look, it's the name of trading that we played. You get me? It's the game that we're playing. So you kind of just have to take the good with the bad, and that will happen. So expect it to happen because it happens, and it happens a lot. So stop losses. I think that's it now. Yeah, that's it for risk. That's it for your trading plan. So sit down and ask yourself these questions. Grab a notepad. I have about 1 million notepads here. 2 more there and 3 more there. All full with notes. don't be afraid to take the notes. Write down your trading plan. Use it, work with it. But what I will say is don't use it for a day and then sack it off. Don't use it for a day and then, oh, I'm after losing 3 trades in a row. Plan the shit, throw it out the window. Stick with it. Back test it. There's no harm in back testing it. And when you back test it, it's better because you build up the confidence in placing the trade then when you're forward testing in live markets. So don't be afraid. Take your notes, especially with your trading plan and risk management and lot sizes and pips. 4 very important videos, 4 very important PDFs. Look over them, read them, take your notes. Blue pen, write it down. With the blue pen, it creates new neurological pathways in your brain and helps you to understand and remember what you're out to actually learning. Better than if you were to do it with black pen or type it down in your laptop. That would be my recommendation. And as always, caution me down below. Don't hesitate to reach out. I'm not a hard man to find. Any questions at all, any inquiries, just fire away, ask. It's no hassle at all. That is trading plan, and we will see us in the next video.